Welcome to the B.F. Anderson Technical Report for May the 6th. Peter Lynch is considered one of the best money managers in history. I thought this quote was interesting. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. You know, Lynch also says we always have something to worry about. So we're always worried about corrections. So let's go back and look at history here for a minute. This is the Dow Jones Industrial Average going back to 1980. Now, Peter Lynch became famous during this bull market right here. But you know, you really have to look at it. You realize that when Reagan came in, basically we had a dip in the market, a real serious pullback. Then we had a correction, then we rallied. Now, this was the crash of 87. This was something I'll never forget. Stocks dropped 30% in one day. So what Peter Lynch is saying is that the corrections are going to come along. There's just no getting around it. Now, the real problem is up here where we see bear markets. So, you know, a correction can start as a correction that eventually becomes a bear market. Correction becomes a bear market. So it's just something that we work very hard at to try to understand. You know, also Peter Lynch had a quote saying that everybody is a long-term investor until the market goes down. Peter Lynch's speech on investing is a must-view for every long-term investor. I've seen the speech. It is a great speech. And basically what he's saying is that you've got to have a strategy and you have to stick with it even when times get difficult. A book I wanted to also mention again is one I've always recommended called The Battle for Investment Survival by Gerald Loeb, who was the founding partner of E.F. Hutton. This book was originally written back around 1936, then there was a revision in the 1950s, but the basic message is you have to learn how to survive as an investor before you start really getting aggressive and confident. So the way you survive is that you do time the market, you know when you're in a downtrend, and probably cash would be one of your better options. Now here is a quote from the book. And it says, obviously our ideas will sound wrong to most people. Any investment policy followed by all naturally defeats itself. Thus, the first step for the individual really trying to secure or preserve capital is to detach himself from the crowd. So basically what he's saying is you just have to quit watching TV sometimes. Now, Bernie Madoff passed away, and I just thought it was kind of an interesting point to mention here that how important it is to understand your strategy, because the deal with Madoff was that when he was asked, you know, about his strategy, he would always say it's proprietary and he can't talk about it. Well, that should raise a lot of red flags. But a lot of very prestigious people invested with this guy, some very smart people invested with him, and they lost approximately $70 billion. Biggest Ponzi scheme ever. Now, let's just take a look at the market here. We're starting to see some problems here in the NASDAQ. You know, if you go look at a lot of individual growth stocks, specifically technology, you're going to have to kind of conclude that they're in bear markets right now. I'm seeing a lot of technology stocks that have dropped substantially from their highs. Now, the rule for a bear market is 20% or more. So a lot of these stocks have dropped 30, 40, and even 50%. Some of them 100%. So the NASDAQ's having problems here. We have gotten a break in the 10-day moving average and now a violation. So I would just say when it comes to growth stocks and technology, they're having a tough time. Now the mid-cap stocks are holding up pretty darn well. Now we did get a break, but we're not getting a violation. So far, so good on this index. The New York Composite, which is all the stocks on the New York Stock Exchange, but it's heavily weighted towards banks and commodity-type companies, and that's where the strength is. We're going to see that in the top 5. Small cap stocks somewhat holding up, actually holding up better than the NASDAQ, of course, but it's holding up. S&P 500, we did get the break, but no violation. Now, we would see a violation down in here, but so far it's holding up just fine. Now, on the longer-term indicator, which is a weekly indicator where we're looking at the 35-week moving average, the NASDAQ continues to stay, even with all the problems we're having, it's still above this moving average, which means we're on a buy signal for the NASDAQ. Now, on the aggression index, now we do this daily, but the actual indicator is weekly, which I'll show here next. But I just wanted to point out that, you know, this is a ratio that measures aggression or what we could call animal spirits, because when investors are buying NASDAQ stocks, technology, and they're not buying consumer staples such as toothpaste, you're going to get a line that is climbing. In other words, this is a growth stock cycle. Then it peaked. It's come down. Now, I would say probably most of the correction, just like back here, most of the correction is probably over. However, it would really be a very positive sign to see this particular indicator stabilize and get back into an uptrend. So the first thing that's going to need to happen is it's going to have to get back above the 50-day moving average, which it's below right now. Now, the actual indicator, we have held the 40-week moving average. You can see here back in the last recession, which was the coronavirus, we broke below the 40-week moving average, but then we recovered quickly and got going again. So we're continuing to see the animal spirits. They're just not there. The aggression index continues to deteriorate, so we just need to be aware of that. Our economic indicators, here's the yield on the Treasury notes. You know, everybody's so worried about inflation, but it's really amazing. Interest rates staying low at 1.593 on the 10-year Treasury note. Oil stocks, oil prices, and we're going to see a lot about oil stocks in the top 5, but you can see here that oil is somewhat turning up. The financial stocks are doing very well. The bank stocks are really strong right now. So it's kind of like you have to use your imagination a little bit and think that maybe there is inflation and interest rates are going higher. Here's the new lows. No problem. We're staying below 40. Not much to say there. Now, on the inverted yield curve. Now, I thought it was interesting. If you want to monitor interest rates, I kind of think watching the yield curve makes a lot of sense. And I did point out last week, this is a new indicator we're using. The yield curve, when it inverts, it's discounting a recession in the economy. The yield curve has inverted in advance of every recession since 1900. So you can see here we got an inversion, a recession. Now we're in pretty healthy territory because it looks like the economy is expanding and interest rates are staying low. Now on the AAII bull-bear indicator, which is measuring sentiment, positive, negative, we got real greedy up in here. Now we're pulling kind of back into neutral a little bit as of the latest survey. We'll keep an eye on it, but we're starting to also see a little bit of improvement in the put-call ratio, which is more of an institutional reading on sentiment. As you can see, we got real deep in greed. Now we're starting to see a little bit of a move back to neutral. We're just not there yet. Now on Visa, which is our particular stock that we're going to use to try to understand spending patterns, we did get a break below the 10-day moving average. However, no violation at this time, continues to stay in an uptrend. Volatility index, we're down here under 20, looking positive, no problem there. Now, on the top 5, you're going to notice here that we're not seeing any technology stocks, and we're mainly seeing commodity stocks, specifically things like steel and oil. So, and you know, if history repeats itself, it basically means that we're somewhat heading towards higher prices, higher inflation. So here we have oil. This is Cimarex Energy. Stocks breaking out, making new high. Looks very positive. This is what's driving the market right now. Here's Cleveland Cliffs, which is steel. Again, you're seeing that breakout here to an all-time new high after a major up move on heavy volume yesterday. Now, Callon Petroleum, another oil and gas stock. You can see here breaking out of somewhat coming out of this base. Again, we're seeing a lot of activity in these commodity stocks. Diamondback Energy, you know, I'll mention Diamondback. This is really a good company. What I've learned about the oil and gas industry is that fracking is a major factor. Now, fracking was invented at the Mitchell School at Texas A&M. So I've been told that if you want to invest with the best companies, invest where the CEOs graduated from the Mitchell School at Texas A&M. Well, that's the case with FANG, which is Diamondback Energy. They have some of the best acreage in the Permian Basin. Matador Resources, this is another energy exploration company. You can see here breaking out to all-time new highs. So that's it. If you have any questions, please give me a call. Thank you very much.